Hi, I'm Jared Davis and I was ranked as the second best performing Forex trader in the world by the Barclays Currency Traders Index. Now in this video, I'm going to go through, trying to think of the word, a kind of a technique or a concept, let's say, a trading concept that many retail traders never even heard of, many retail traders miss, and they don't even know exists. And the concept is that of qualitative versus quantitative focus, okay? Now you might be standing thinking, what does that mean? I've never heard of that. And I'm going to explain what it is and how you can use it in your trading. Now, if you've ever tried to trade the news, very likely is you've gone to the calendar and you've looked at a news event, it's a red high impact event, and it's came out positive, green, positive, and you think, okay, well that currency is going to go up. And then you look at it and the currency goes down, and you're like, what happened there? Vice versa, the number came out really bad, and you think, oh, I'm going to sell that currency, and the currency goes up. And you think, what is going on? Why isn't the market moving as the news comes out? If the news is good, surely the market should go up. Well, it's not quite as simple as that, and I'm going to explain how you can break it down and understand it a little bit better. Now, the reason for any market move is based on the market's expectation or traders' expectations of how the central bank are going to act. Now, the central bank are very clear in what they're thinking. They will tell the market what they're thinking and how they're thinking about acting in the near future. The traders then use this information to trade the price of the currencies, okay? So, one of the things the central bank will do is it will say, to keep it simple, when it has a goal, let's say it's trying to get inflation up, let's say it's trying to get inflation down, whatever the goal, the central bank will say, well, basically, we will look at raising interest rates, or we will look at doing this as soon as this figure gets below or above this level. So as an example, in the US, when they were doing their quantitative easing program, the Federal Reserve stated clearly, we will look at raising interest rates, we will talk about that, have that discussion, as soon as unemployment gets below 7%, okay, or 6.5%. So traders instantly knew that as long as unemployment was higher than 7%, there's nothing to worry about, no one's going to raise rates, everything's going to carry on as normal. It was very, very clear. Now, that's a scenario where you can just literally trade the figures. Very simple, very clear. The central bank will do that when the goal, their target, well, their goal that they're trying to achieve is far away from being achieved. So they can just say, well, let's just look at that figure. Until that gets below there, you've got nothing to worry about, basically. Don't bother. You know, that's what you need to focus on. So traders go, okay, cool. It's, you know, it's 7.5%. It's got months and months to go before it gets below 7. We're not going to worry about interest rates or anything else. We're not going to speculate on anything because that's what you've said. It's very clear. Now, the problem comes when those figures now start to get down towards those goals. Then the markets start going crazy, speculating. Okay, so it's at the level, the quantity level, that's quantitative guidance. The quantitative level that the central bank has set is almost reached. We're getting excited. The markets get volatile again. To calm the markets down, the central bank will then switch from a quantitative to a qualitative. So what they'll say is, okay, unemployment in the example is getting now down towards our goal, that's fine. What we're going to do now is before it gets there, we're going to remove that. Forget that now, we're not interested in that. What we're interested in now is the quality of the employment. So just because there's more people in jobs, now we want to focus on what kind of quality those jobs are, okay? Is it 0-hour contract? Is it just part-time jobs that no one really wants? Is it low-paid work? Are the average earnings of each worker in the country, are they going up or down? Because there's no good having more jobs, there's no good having more people in work if their quality of life is getting worse, okay? So they'll switch to now a qualitative guidance and they'll kind of look behind the headline. So maybe the next month, after they've made that switch, unemployment now is at 6.5% or 6.3%. So you think, oh, it's absolutely fantastic. It's a green figure, it's positive, buy the currency. But if you look behind the figure, you see average hourly earnings have actually gone down. The quality of the employment is really weak. The jobs are not actually any jobs that most people want. Or you say that actually the reason the unemployment has gone down is because less people have even bothered looking for a job. Okay, they're just given up completely, which is even worse. Okay, so it's a little example of why the headline figure doesn't always tell you the true picture, and you need to know about quantitative versus qualitative guidance. If the central bank are focused on figures, then the calendar will be tradable. Okay, good figure, currency goes up, bad figure, currency goes down. If the central bank are focused on qualitative guidance, the figures are almost irrelevant. It's the data behind the figure. How good of a quality figure is that will move the markets. So very often when you've seen the price go in the opposite direction to the figure, that's what's happening. The markets are looking beyond it and thinking, you know what, actually, even though it's a good headline, it's actually not that good. We're going to sell it off, or, you know, it's actually better than it looks. We're going to buy it up. So I hope that helps. That's the difference between qualitative and quantitative, and it all stems from the guidance issued by central banks. That's why, another reason, you need to keep focused on what the central banks are saying so you can accurately predict and determine which way the market's going to move from those economic releases. So please keep your questions, comments coming. I'll be back soon with another video.